In every country, there is a special institution that works behind the scenes to keep the economy healthy. This institution is called the central bank. Think of it as the financial guardian of a nation. Just like a doctor takes care of our bodies, the central bank takes care of the economy. Central banks have a critical responsibility to ensure economic stability. They work to control inflation, which is when prices of goods and services increase too quickly. They also strive to promote economic growth, meaning they want to see more jobs and businesses thrive. The work of central banks is complex and multifaceted, but it boils down to managing the country's money. They influence how much money is in circulation and how easily people can borrow it. By doing so, central banks try to create a stable environment where businesses can flourish and people can feel confident about their financial futures. In essence, central banks play a vital role in our daily lives, even if we don't always see it. Their decisions impact everything from the interest rates we pay on loans to the prices we see at the grocery store. Understanding the functions of central banks is key to understanding how our economies function on a fundamental level. One of the most important roles of a central bank is managing the country's money. This includes issuing currency, controlling the money supply, and setting interest rates. Central banks are usually the sole issuers of physical money, like bank notes and coins. This gives them a powerful tool to influence the economy. The central bank manages the amount of money available in the economy, often referred to as the money supply. They can increase the money supply by printing more money or by making it easier for banks to lend money. Conversely, they can decrease the money supply by slowing down the printing of money or by making it harder for banks to lend. Interest rates are another key tool used by central banks. These are the rates at which banks lend money to each other and to their customers. By adjusting these rates, the central bank can influence how much people borrow and spend. Lower interest rates encourage borrowing and spending, which can boost the economy. Higher interest rates do the opposite, slowing down borrowing and spending to control inflation. Through these actions, issuing currency, managing money supply, and setting interest rates, central banks act as the caretakers of a nation's monetary system. Their goal is to maintain a balance that supports economic growth while keeping inflation in check. This careful balancing act is critical for a healthy and stable economy. The strategies and actions taken by a central bank to control the money supply and interest rates are collectively known as monetary policy. This is a powerful tool used to influence the overall health and direction of the economy. When the economy is sluggish, the central bank might implement an expansionary monetary policy. Expansionary policy often involves lowering interest rates to encourage borrowing and spending. This can stimulate economic growth by making it easier for businesses to invest and for consumers to make purchases. On the other hand, when the economy is growing too quickly and inflation becomes a concern, the central bank might implement a contractionary monetary policy. Contractionary policy often involves raising interest rates to slow down borrowing and spending. This can help to curb inflation by reducing the amount of money circulating in the economy. The central bank carefully analyzes economic data and adjusts monetary policy accordingly, much like a captain steers a ship. By making adjustments based on the economic climate, the central bank aims to keep the economy on a steady course, avoiding the extremes of recession and runaway inflation. The goal is to create a stable environment where businesses can thrive and individuals can feel confident about their financial well-being. In times of financial panic or crisis, the central bank takes on another vital role, that of the lender of last resort. This means that the central bank stands ready to provide emergency loans to banks and other financial institutions that are struggling to stay afloat. This function is crucial for preventing a financial crisis from spiraling out of control. During a crisis, banks might find themselves short of cash, unable to meet their financial obligations. This can lead to a domino effect, with one bank failure triggering others, ultimately threatening the entire financial system. The central bank, as the lender of last resort, steps in to prevent this catastrophic scenario. By providing emergency loans to struggling banks, the central bank can help to stabilize the financial system and prevent a complete meltdown. This role is essential for maintaining confidence in the banking system and preventing widespread economic panic. It's important to note that the central bank doesn't bail out every failing bank. The goal is to provide temporary support to solvent institutions facing temporary liquidity problems. The lender of last resort function is a critical safety net that helps to protect the economy from the potentially devastating consequences of financial crises.